Joining me is Jeff Currie. He's Goldman Sachs head of global commodity research. Jeff, it's good to have you. So rattle off, if you could, all the commodities that you specifically think stand to benefit here.
Well, when you look at the inventories across the entire commodity complex, it's easier to give you the number that are not bullish. Coffee, cocoa, and iron ore are the only commodities that are not in a deficit right now. And that's really rare given where we are in the current cycle. I mean, we were at a trough of a recession 6 months ago, yet we have every single market in a deficit with the exception of those three that I just rattled off, which underscores the structural underinvestment in supply that we have. Because as you just mentioned, demand across most of these markets is tepid. Even in oil, it's tepid, which underscores supply is really the driving source here.
That's interesting, and I should give you a hat tip because back in the spring when oil went to minus 30 a barrel, there was a big debate about whether it would keep going negative or not. And I remember you coming on this program and saying, no, that you thought the supply and demand situation was going to push us back up into positive territory and, to the 30s ultimately, and that's exactly what happened. So sticking with oil for a moment, where do you think we're going from here on WTI, which has huge implications for a lot more of the deal activity that we may or may not see into next year?
Well, when you look at the non-energy commodities, you want to be long them right now today, particularly the investment goods like copper and the rest of them, because they have very strong demand that's being driven by a lot of these policies directed at infrastructure projects. In contrast, when you look at oil, the demand is still really weak, which means it'll probably trade sideways until you whittle down that inventory overhang. Right now, there's about 800 million barrels of excess inventory that needs to be worked through. We think the earliest you can work through that is by the end of this coming winter, which means sometime like second quarter of next year, which is when you can tactically start to see real upside in oil. Our target at the, going into the second half of next year is $65 a barrel, which is really far from here. But I do want to emphasize, don't get too excited yet because you still have that 800 million barrels that you need to work through. What's driving that tepid demand is the loss in jet fuel demand, which means you either need a vaccine or get rapid testing in there and get people back into the sky.
Yeah. So basically you're saying, if I heard you right, you said you can buy pretty much all the non-energy commodities right now, that it's oil that has this particular supply overhang, but everyone else is pretty well positioned. In fact, reading from your note, you say, we recommend long positions across silver, copper, jet regrade, Brent, U.S. gas, and gold, which is why you're recommending the broad commodity basket. But so this is fundamentally a demand recovery story. Is that right? And is it predicated on anything that has to do with the election outcome or another round of COVID relief?
No, and actually I would argue it's not predicated on a demand recovery because in the non-energy commodities, you already have the demand there. What it's really predicated on is the structural underinvestment in supply. This is a story very similar to what we talked about 20 years ago. We called it the revenge of the old economy then. It's the same story. The new economy has siphoned off too much capital that would otherwise go into these old economy industries. Then you layer on top of that ESG concerns. The ability to raise capital from either debt or equity is really difficult right now. And, that's why we argue you have to go all the way to 65 because these producers are going to have to drill out of cash flow, something they haven't had to do for decades.
Shepard Smith here. Thanks for watching CNBC on YouTube.